Welcome back to the conference, and I hope you've had a good time so far. The next speaker is Masja Zandbergen. She is Head of Sustainability Integration at Robeco, where she is responsible for coordinating ESG efforts across all asset classes. We first met Masja in 2019 when some of us spent an entire day at Robeco's headquarters in Rotterdam discussing sustainable investments together. As many of you will know, Robeco has been our main partner for systematic equity strategies for about 3 years now. And we've also worked closely together to further integrate ESG factors across our equity solutions, and in particular in our Global Sustainable Equity Fund. Today, Masja will show us the 50 shades of green, driving us all the way from sustainability integration to impact investing. Masja, over to you.
Thank you, Lorenzo. Good morning, everyone. Let's talk about 50 Shades of Green and the move from ESG integration to impact investing. Actually, the Shades of Green concept is really not new. In 2014, it was already established by the G8 Social Impact Committee when they plotted different strategies, sustainable strategies across the capital spectrum. And they really said, on the one hand, on the left-hand side, you have finance only, where you construct portfolios only to generate superior investment returns. And on the right-hand side, you have investments for impact only, where you invest for social and environmental impact and don't expect any investment returns. And of course, there's a lot of shades of green in the middle. And there are 3 shades of green in the middle that we actually see the most in the market. One is called responsible investing, where you really use ESG information to reduce risks or generate better investment returns or make better investment decisions. And then we have the sustainable investment strategies, where you use ESG information to really create portfolios that have better ESG characteristics and also in that way enhance value. And then the third one is really impact investing, where you only invest in those areas and business activities and companies that actually generate positive socio-economic impact and also generate good investment returns. And these 3 strategies are more or less the strategies that you find out there in the marketplace. So let's look at the sustainable investing market developments. A recent report that came out from the Global Sustainable Investment Report 2020, it came out last month, where we look at growth in the assets under management in sustainable investing. That report actually found that there's still quite a lot of growth in the assets under management that can be categorized sustainable. Now, interestingly enough, when you look at the orange bars in this graph, from 2018 to 2020, we see a decline in assets under management in Europe. And that is because the European regulator is becoming more and more strict in terms of what type of assets under management can we actually call sustainable or responsible or impact. And due to that different categorization, actually the AUM that was considered to be sustainable or responsible have actually declined in Europe. But we're seeing a lot of growth in the other markets like the US, like Australia, etc. So the market is really still growing quite substantially. And then when we look at underlying, what are the most important strategies that are growing, and we see that it is ESG integration, so really the responsible investment, bit of active ownership, and the biggest growing part over the last 2 years has been the thematic investments. And I think thematic investments are really related towards more the impact investing area. And actually we've seen the same when we look at our own business at Robeco. We have seen that our ESG integrated assets have grown over time to over 85% of our total assets now. And you can imagine that there are certain strategies, like strategies that have built up purely from derivatives, that we cannot integrate ESG yet. But where we can integrate ESG, we do it. This figure now will probably grow just as fast as our assets under management will grow because we've done almost all we can. And then when we look at the sustainable and impact strategies, the second two categories, we also find that there is still strong growth. And we actually find that in 2020, for the first time, our impact strategies are actually overtaking, in terms of assets, our sustainable strategies. And we see a lot of demand for climate solutions, for solutions that play into companies that contribute positively to the UN Sustainable Development Goals. And also the thematic strategies are growing quite fast. So this business is becoming is growing at a good rate. Now let's take a look at how you can actually implement sustainability, the different types of sustainability in your investment portfolio. And I think the concept of double materiality is something that I'm hearing more and more. And we really want to distinguish between those two. So on the one hand, you have ESG integration. Think about how do ESG issues, how do long-term ESG trends actually affect the companies that we invest in and affect the business models. And that's really, if you understand that better, it's really about making better informed investment decisions. On the right-hand side, it's about impact and impact investing. And there it's exactly the opposite. You're looking at how does the company that I invest in influence ESG? How does the company influence sustainable development? And there you can think about, okay, I'm investing, but I really want to reduce my negative impact, or I don't want to invest in certain areas of business. Or you can say, let's invest in the winners of the future, in the companies that actually play into these trends, like renewable energy, like smart mobility, healthy living, etc., etc. So two different concepts. One is looking at how does ESG affect the companies I invest in? The other one is looking at how do the companies that I invest in affect sustainable development? And of course, you can combine all of these things in one portfolio, but you're doing it with different reasons. ESG integration, you're doing for better performance. Impact investing, you're doing for both better performance, but also better environmental and social outcomes. Now, let's take a closer look at ESG integration. So I think ESG integration, as I already said, is really about understanding long-term trends and their impact on the companies that we invest in. And we ask ourselves, when we analyze companies, we ask ourselves a few questions. The first one is, how is value being created in this industry? The second one is then, what are the long-term trends, the mega trends? What are the ESG issues that could affect this value creation in the long run? And then, of course, we have to think about, if you add those two up, you come up with, okay, so what are the long-term intangible factors that companies need to manage well to be able to be prepared for the future? And then we can link that and have a rationale to how that is affecting the business model of companies. And then we have to think about what are the KPIs that we can measure to understand which companies are doing really well and which companies are doing not well. And there's been a lot of research in terms of ESG scores. You have a lot of different data providers, and the correlation between these scores is quite low. And actually, it turns out that a big reason of that, 50% of that difference, is actually explained by the fact that these underlying issues are being measured by different KPIs. So you can understand that if you are measuring the training of people as part of human capital, if you're measuring the percentage of the workforce that has been trained, or if you're measuring how many hours have these people been trained, you can get to completely different outcomes. And you're trying to measure the same issue, but you're getting completely different outcomes. So it's very important to think about how do you measure the performance on these specific issues. And then lastly, once you've done all that, you do your analysis, and then you can form an opinion on which companies are prepared and which are less prepared. And that then, of course, will influence your investment decision. So let's do an example of the internet sector. How is value being created? Well, of course, value is being created by assembling, collecting consumer data, and then doing something with it. So generating your revenue based on that. Now, what are the long-term ESG trends, or what are ESG frameworks that could affect that? Well, it's the basic human right to privacy, of course. And then, of course, if you add those two up, data privacy is an intangible factor that this sector needs to address, at least in some markets, not in all markets, but in some markets. And then the question is, how does that link to the business model? Well, of course, we've seen in 2014, 2015, when we had already seen this issue as relevant for internet companies, the market really didn't care. But we had said, okay, if data privacy is becoming a bigger issue, is if there are going to be data breaches or other issues, it's going to increase the cost for the companies, and also in the long run, because they will need to hire more people. And it's also going to change their business models a little bit. So they also need to maybe have a lower profitability. And indeed, when in 2017 this became an issue, we saw that actually the regulators started looking at it, specifically also in the US and in Europe. They were a bit earlier. And we found that this was actually becoming quite an important issue for these companies. And we had already addressed that in an earlier stage. So then how do we look at which KPIs do we look at? Well, we look at how, and to what extent is consumer data being used in the business models. And secondly, also there are human rights privacy indices that you can actually look at to measure how companies are doing. And then we need to form our own opinion on it. So we look at what are the policies that are in place, or is there risk management on this topic? Is the company transparent? When something goes wrong, do they show it to us, and do they explain to us how they're going to improve? So that is how we formed an opinion on the companies, and that really helped us when really the topic became important in 2017. So it's all ESG integration, all about understanding what are the long-term issues that can affect the companies that I invest in, and the ability for them to really generate value, long-term value for shareholders. Now, I don't say that we should forget about short-term value creation, but there's already a lot of, efforts put into that. And this is really giving you an extra lens to think about long-term issues. And you never know when they're going to hit, of course. And then impact investing, the other part of the double materiality I just explained. I'm talking about listed securities now, so not about direct investments in real estate or in infrastructure or in microfinance, but really how do we implement impact investing in listed securities? Now, how do companies create social and environmental impact? Well, of course, they have inputs, they do activities, and then they create outputs. And the outputs are products, and they might be also, pollution or wages, and that generates outcomes. So it generates happy workers or unhappy workers. It generates dirty rivers or not dirty rivers. And in the end, that generates an impact. So that generates impact on climate change, on biodiversity, on the happiness of people, on the economic development in the region. So really, how do companies in the whole value chain in the end create impact? And we have impacts that we are aiming for, but there are also impacts that are not being aimed for, and they are often negative impacts on environment and social issues. So how then can we make a change when we invest in listed equities or in credits? What do we look for when we invest, when we want to do impact investing in companies? Well, first of all, we look for significant revenue contribution. So there needs to be a positive contribution by products or services to one or more of the Sustainable Development Goals. Then, of course, the second is that there should be not a negative impact to some of the SDGs. And what we also say is that emerging markets exposure, often we find that positive because those are often underserved markets and markets where change is also quite needed. And then we say, taking all of that, a minimum of 33% of positive contribution of revenue in certain areas that we link to positive sustainable development can then actually lead to a positive score for a company. Of course, we have to make sure that they don't have negative impacts in the remaining 66% of their revenues, of course. And we have set also specific KPIs to measure that per industry. Now, what we also look for is high value proposition. So you can make wonderful medicine, but if it's only available for very rich people in Western countries, it's not really going to create sustainable development. So what we want to see is products and services that are value for money and at low cost. And of course, also we want to see new business models that actually generate those low cost products. And then lastly, we want to see additionality. We're not putting additional capital to work, which is traditionally if you invest in renewable energy parks or in infrastructure, different types of infrastructure, or in microfinance, you're adding capital to a certain market. We're often not doing that in a listed space, only if we have an IPO or secondary offering or bonds coming to market. But we look for additionality in the new products, in innovation, in new business models, in expansion to underserved markets. And we really look for companies that are changing the status quo. And that's how we address the additionality topic of impact investing. So just to give an example, Novo Nordisk, a company that creates medicines, a very innovative company. It's a company that makes medicine for hemophilia, for example, and they also create new models to make sure that they serve their customers the best. And we find that they contribute positive to SDG 3 and to the underlying targets of the SDG 3, which relates to health. Second example, Bakkafrost is a company that is active in salmon, and they have very sustainable salmon. And also, salmon is from a health perspective very good product because it contains a lot of omega-3, very healthy fat. So we consider that to be a positive contribution again to SDG 3 health. Whereas we're seeing that a lot of other food companies that are very diversified, they don't meet the threshold of the 33% of revenue of really healthy, sustainably sourced, organic foods. So it's very difficult to find in a very diverse food company to find companies that actually contribute, we believe, on a net basis positive to sustainable development goals. But in this case, this company really fits the bill and it's an interesting company to invest in from that perspective. And then, of course, if we know all of the underlying companies that we invest in, and these are two examples from Healthy Living portfolio, we can actually calculate based on a lot of assumptions, based on underlying academic research, we can actually calculate the amount of people that is actually supplied healthy food to, and some of the other characteristics by the companies that we invest in. And then we can actually show what the portfolio companies are contributing to sustainable development and how many people they are reaching. And it gives us some idea of the impact that you're actually making by investing in these companies. And again, there are a lot of underlying assumptions. It's not a science, it's an art, but at least it gives us some ideas. And we're now actually expanding this framework to all of the SDGs. These are a few examples on health. We also have examples on renewable energy. But when you look at the total SDGs, it's quite interesting. And we really have to put more effort in measuring this, because you can actually then also compare between different companies that you're investing in, companies that are generating the biggest impact compared to companies that are generating a less big impact. And if you have a goal of creating both impact and financial returns, it's something that you need to balance. So we can really measure very well our financial returns, but what about the actual impact that we are making? So this is a very important piece of work that we need to develop further. But really, hopefully I was able to explain to you what do we consider impact, how do we invest for impact, and also how do we measure for impact. And now the last topic is to give you an example of how we actually implement this into an investment portfolio of one of our clients. And I'm talking about a quantitative strategy now. So we have a client that used to invest passively in an MSCI world, but they thought that sustainability was really important. So they really wanted to add that aspect, but they still wanted to have that passive-like, market-like return. So what we created for them was a portfolio with a better ESG score, with a lower footprint, with some exclusions, but still with a very low tracking error and a good exposure to factors that actually would lead to market-like returns. And we actually did better for them than that. So we actually created an outperformance. And that gave them a lot of confidence over time. And they were actually becoming more and more convinced that they needed to add more sustainability, and specifically with a focus on climate, because climate change, we've done some research, 88% of investors globally, institutional investors, believe that climate will be a factor or will actually be core to their investment strategies in the next 2 years. So it's a really important topic. So they wanted to really move a step further. So what we did for them is to create a portfolio that actually had more exclusions, also on fossil fuels, that had a 50% lower carbon footprint than the benchmark, and also with the possibility to do the 7% year-on-year footprint over time to be in line with the Paris Agreement. And then also, and this was very important, to focus on those SDGs that really are focusing on climate. And in the end, this is what that looks like. So the blue bars are the benchmark, the red bars is the exposure in the portfolio, and below you can see all these sustainable development goals. And you can see that we really focus the portfolio on the SDGs that the client found really important. And those are not only the climate SDGs, but also decent jobs, because the client also really wanted to invest for a just climate transition. So not only the environmental aspect, but also the social aspect was deemed very important. And we were able to build a portfolio that tilted towards those SDGs, the 50% lower footprint, and also, of course, a slightly higher tracking error, but still very good exposure to the traditional financial factors. So really integrating all of that. And I think that's an excellent example of how you can combine all of these concepts into one portfolio. So to wrap up, sustainable investing still quite growing. There's a focus on ESG integration and thematic investing. There is an increased, notion of the notion of double materiality. So not only ESG integration, but also impact investing is becoming very important. ESG integration, all about making better informed investment decisions, understanding the long-term trends that affect your companies, and impact investing really about generating not only good financial returns, but also positive environmental and social outcomes. And I hope that this presentation has given you some insights into how you can actually implement both concepts in a portfolio. And I hope that you would consider adding more impact to your investment portfolios, more positive impact. Thanks you very much for your attention.